Okay. So if you want to look at the annual balance sheet, you can just type in, just get rid of the quarterly. Just get rid of that. And voila, right? But remember the transpose? We have to transpose it because this is not the format that we can analyze. So you want to look at the transpose, that T. And I can't type. What's going on? I'm using a new computer. That's why its laptop is a little funny. So now you can see that this is the format that we want, where the attributes of the table is on the top, and the dates are the columns are the attributes, and the rows are the dates. This is the one you want. Okay. So let's take a look at this data. Okay. So this, remember, here's the thing. If you do balance sheet.t, you only get 4 years, the past 4 years. But if you want to look at past, I don't know, 10, 15 years, you can't use your Yahoo Finance because, well, look, this is what it gives you. So Yahoo Finance scrapes the web, and if the web has this, then this is all you get. So that's the unfortunate downfall. Even though Yahoo Finance is super easy to use, I mean, super like awesome, right? Maybe we should do like one of those like change.org asking Yahoo Finance put more information or something. But anyway, so if you wanted to go longer time frame, then yes, you do have to get different data source. And I think in the first 2-3 episodes, I use like one company. So feel free to take a look at that. I think they're free as well. I think it's like a freemium or something. But here's one caveat, right? I think I mentioned this like 2-3 episodes ago, is that probably in the next 10 to 15 years, maybe 20 years, half of the S&P companies that exist now will probably be gone, right? Because software, as I mentioned before, is changing everything, right? Now, one winner take all effect happens. I mean, if you look at YouTubers too, right? I mean, I don't have that many subscribers, but some of these guys, like, I mean, they don't talk about finance, but some of these guys have like 6 million, 10 million. Like, I think the highest one I've seen was like 25 million subscribers. Like one dude, right? One dude with a laptop and a mic. And it's not because he's like just awesome guy or something. It's because algorithmically he has benefit. Like he somehow like he figured out how to sort of like work the system, so to speak, to give the algorithm to give him exposure. So you understand, like even look at Facebook and like Google, right? These guys have dominance in advertising, right? Apple too, right? Like one winner take all, and it's because these guys invest heavily into software. So that's another reason why you guys should be doing more data stuff, is because we are entering that world where analog, if you live in the analog world, you're gonna get wrecked, right? Like take a look at Amazon, right? Amazon market share in retail is like, damn, 41%. That is insane. Look, it just keep going up and up and up and up. Oh, this is e-commerce. Well, anyway, it's still pretty big, right? So between Amazon and Walmart, these guys pretty much have e-commerce, locked in, right? Yeah, there's Shopify and there's like all these like WooCommerce and these other platforms, but just can't beat them because they have the software advantage, right? So the reason why I tell you this is because you don't want to look at the data so far back that they're like irrelevant. Like for example, some people look at data past 2008. 2008 was when there was a huge real estate crash, and like bunch of things changed, right? Like Wall Street changed, regulation changed, all kinds of stuff changed. So if you look that far back, I don't know if that's relevant. Like I don't know if the world back then is like, you can say like P ratio of this. I mean, I don't think it applies, right? So this is one of the reasons why like Warren Buffett, value investing stuff, you got to sort of take it with a grain of salt. Like the strategies are different. Like the principles are the same, right? The company should be safe. You should have competitive advantage. You should be growing. You should have, you own more things that you owe. Don't take too much debt. Growing and has lots of free cash flow. Blah blah. Yes, that the basic principles are the same, but the strategy, right? Like the Benjamin Graham formula, like, right? There's a guy. He's he says like, oh, like this, yeah, here it is, like this formula, this formula is not, you can't use the formula anymore, because he's like, well, price of book, it has to be this, and what's going on? Yeah, price of book has to be this, and price of earning has to be that, and I expect this. Come on, dude. Benjamin Graham, he wrote his book in 1974. Come on, 1974, like Microsoft didn't exist, right? So anyway, the reason why I tell you this is because, yes, don't far look too back. In my opinion, like past 3 to 5 years, in my opinion, is a good indication, right? So, all right, so that's the balance sheet, right? So let's take a look at this. So how do we know this guy is he owns more things than he owes, right? This is, okay, so press Alt Enter. So total shareholder, so let me go back here. So we want to make sure that this formula, A equals L plus E, right? We want to have less liabilities and want to have more equity, right? More equity. So let's take a look at that. So let's take a look at these columns. Which one of these should we plot? Let's see, type columns. Okay, so there's intangible asset, total liabilities. There's many things you can do. For example, like I wouldn't do property, plant, and equipment because Microsoft is obviously not, they don't have factories and stuff. But if you're like Nestle or something, or you're like a factory, like Taiwan Semiconductor or like Huawei, those guys, like they actually have factories, right? Like those are assets, right? So you might want to plot that, but it all depends. But let's just look at the simple ones. So total assets, let's graph these two, total assets and total liabilities. So let's graph those two. So we're gonna do that MSTFT dot balance sheet dot T dot columns, and then you can say total assets and total liab. So here's the thing, right? Yahoo Finance, like their wording isn't consistent. So some of them will say like liab, some will say liability. So I mean, that's just, I don't know if it's a Y Finance thing, but I noticed that it wasn't consistent. So just be on the lookout for that, okay? The wording is not necessarily consistent throughout the different tickers. So let's just plot this. It won't let me do that. Huh. Okay, actually, let me take a look at this one. Let's take a look at the assets, total assets. Oh, sorry about that. Yeah, so there is no dot there. Total liab. So you'll notice the total assets is going up, right? And liability is relatively the same. Actually, we might as well put the equity as well too then. Total shareholder equity. Let's plot this thing too. Let's plot that thing as well. Okay, so assets are going up, right? Liability is relatively the same, right? But total shareholder equity is going up, right? So this is good. Remember this? Like this. So liability is the same, but the equity went up and the assets went up. So that's great, right? So this is a great trend. You want to be looking for this, right? Now let's take a look at the cash flow. Yeah. So cash flow, you can take a look almost identically, the similar syntax. MSFT dot, let me just check for 1 second. I forgot the syntax. So the way you're gonna check this is by looking at Y Finance. So like, I mean, these aren't like, this is not my library. So like this guy has his own, here we go, cash flow. Yeah, here we go, cash flow. Microsoft that cash flow. Yes. And then let's take a look at .t. Yes. Okay, great. Let's plot this. Remember what I said, right? You want the cash flow. Actually, let me show you the columns. Columns. Why can I type? Okay. You want the cash flow from operations to be positive, meaning that you're making money selling your core business, right? Like selling your product, whatever thing you sell, or whatever widget you sell. That's got to be positive, right? Cash flow from financing activity should be, in general, should be negative, and from investing also be negative. Which what that means is you're spending money to expand your market, right? Expand your market share, expand shops, and that's the cash flow from investing. And financing, you should be paying down your debt. You should be paying down you should be paying off your investor, right? That's the general, but it's not always the case. Like if you take a look, I show you like what is that company? So like REIT. Well, okay, I'll get to it. But companies that have to raise money to expand, like for example, like you're like a real estate developer, like you have to get new money, right? What are you gonna do? You're gonna put a building on top of another building? Like you can't do that, right? You have to buy land. You have to like buy more stuff, right? So like AT&T, Verizon, a lot of these companies, like if you want to expand your network, you have to build more cell towers. You have to like hire more people. And look at airlines, right? If you want to have more routes, how are you gonna do it? Like you have to buy more airlines, right? You have to buy more airplanes. You have to like, deal a structure with the government so they can like fly over their land. And if you're at airport, they have to rent space, right? So that their plane can dock and stuff. So they have to spend more money. So this is one of those companies that Warren Buffett doesn't like, right? He doesn't like companies where you have to constantly put in cash to make money. Well, that's the unfortunate side of things, but the good things in life, right? The things that have the most impact in life, like for example, I don't know if you guys know, but money spent by average American by trend, by industry. So I don't know if this data is good. Okay, so basically, people spend money on. If you're in a developed country, people spend their money on the most of their money on three things other than tax. We're not including tax. Number one is housing, because housing is freaking expensive in most cities in general, but like developed countries, like their cities like New York City, Tokyo, Singapore, like their housing price is crazy, right? Number one is housing, and number two, where's my finger? Okay, number two is healthcare and or transportation, right? And food is very little, like cost of calories consumed, like the amount of income you spend per calorie in developed countries is very little, right? In developing countries, like slightly higher, but in those areas, people spend the most money, and that's why this cash flow stuff is important, because things that have a big impact in life, like housing, right? You need to have housing. Those things have they have positive. The cash flow from operations and cash from investing aren't negative, right? They are not negative. You have to constantly put money in to get more housing. You have to constantly put more money in to get new roads, right? So you can't just take a look at a company and say, oh, this company, this guy on YouTube said, like, if the company has good cash flow from operations, but, if they don't have negative cash flow from investing and financing, then they're not good companies. No, that's not true. That's not what I said, okay? So a lot of companies can't do that because, like Microsoft, for example, they make one, they write code once, they sell it like, billions of times, right? But like if you build a car, you can't like sell it billions of times. So you just have to keep building cars, right? So that's why you got to take a look at. So you can't take a look at the trends that I tell you. Is not universal, okay? In general, I'm speaking in generality, okay? So let's take a look at these charts, okay? So Microsoft, and that's another reason why I chose Microsoft, because their charts are like super easy to understand, right? Like REITs, like guys that do mining, guys that do like Toyota and stuff. Like it's complex as hell. I mean, you have to be like you have to have done this for like years and have a team of like army, like if you go to Wall Street, they have like whole buildings of people. All they do is just crunch numbers and they just try to analyze this stuff, right? I mean, so for like solo investors like us, it's not practical. Okay, so anyway, let's go take a look and let's plot plot these things, okay? Oh, by the way, if you guys don't know what the syntax is, right? This, like you have a double bracket, right? Double bracket. That means just plot all three, right? So this is a list, okay? This is actually, the inner is a list. Sorry, the first bracket is a list, and the outer bracket is actually is a hash. I don't want to get into it, but it's basically it's basically a dict, like a dict, but the inner is a list. But anyway, this just means just plot that, okay? So I don't want to get into it. So let me take a look at. So we want to get total cash flow from financing activities, right? We want that, so we put it there. Total cash flow from investing activities. Okay, and we want to get total cash flow from operating activities. All right, so we got the three things, okay? And we want to dot plot. Okay, so take a look at this. So their cash flow from operating activities is like super up, right? Like this is great. This is a great looking chart, right? And look at this. Their red thing, cash flow from investing activities, is like negative. Yay! This is a great thing. That means they are spending more money to like build data centers and like I don't know, like whatever they do, right? Like they buy companies or something. And cash flow from financing activities is also negative. That means they're paying down their debt. They're like they're maybe like I don't know, like doing share buyback or something, right? So they're using money to like make their stock worth more, right? So it's good. You want this kind of chart, right? You don't want it to be where all the things are like positive, like all three lines are positive and like pointing to the right. That means it's like they're raising money to do more stuff, right? So it could be like airline, like I said, factories, power plants, like I don't know. Let's take a look at Tesla. I haven't taken a look at Tesla, but I'm guessing they're probably like somewhere like that too, right? But look at Tesla; they're kicking butt. So are they necessarily a bad company? Actually, let's take a look at Tesla. So it's TSLA, right? So look at the financials. If you look at their cash flow, so their cash flow from operating activities. So notice is, oh man, they're kicking butt. Jesus. Okay, so they were negative in 2017 and then like positive, right? Their investing is negative. Okay, so they're, oh, here we go. See the negative, they're positive. So that means they're getting financing, right? They're receiving financing. That's why it's positive. Remember, cash flow, if the number is positive, that means coming to you. If it's minus, means it's going away from you, right? So going back here, yes, you want the financing investing to be going away from you and operating cash flows from coming to you, right? So I think I'm gonna stop here for now. So this is like basic stuff, right? We're going to like more ratios in the next one. But anyway, if you like this, make sure to thumb up. Okay, thumb up is like YouTube. I don't know. I'm sure like this is not the only YouTube video you've watched, but that's our currency, right? Like thumbing up and commenting. I'm sure there's something I said in there that didn't necessarily make sense or something, because I'm doing this ad hoc, right? I kind of prepare, but I try to do ad lib as well. So put a comment, questions. I'll try to answer as best I can. Like there's certain things I can't answer. Like if you ask me about like a lot of people ask me about India stock exchange stuff, but I never dealt with their data or like if the accounting is similar or something. So I haven't dealt with that. But anyway, I'll try to answer best I can. Oh, one thing that I wanted to say was about that Mr. Wonderful guy like taking dividend. Startups need cash. Okay, so if you're an investor investing in startup and expecting dividend, no, that doesn't make sense. Anyway, that's it for today. I'll see you in the next video.